Hello, my name is Carlos Pascual, Senior Vice President for IHS Markit for Global Energy. It's a pleasure to welcome you to this live session of CERAWeek Conversations. And today we have an extraordinary treat, an opportunity to explore the issues that are guiding economic recovery from the pandemic with the heart of the IHS Markit economics team. But before we go into the details, let me cover a couple of logistical points. You can see here the key people that we have in front of us are senior economists that are covering global issues, U.S. issues, China issues, Asia issues. I think it's going to be an opportunity to really have a wide-ranging discussions. I want to remind you all that we have an opportunity for your questions and answers. So as we go through the discussion, there's a Q&A button. Use it, submit it to us, and we'll be thrilled to get your questions as we go along. At the end, you will see a survey, and we really appreciate your completing the survey and sharing your thoughts with us. And finally, I just want to underscore that we are continuing these CERAWeek conversations as an opportunity to really explore some of the driving issues behind energy transition, economics, finance, and technology that are affecting the world that we have today. In this conversation, one of the things that we want to do is to explore what's happening on global trends in the business sector, drilling down into the United States, drilling down into China, and what it all means for what a path to economic recovery might look like. And let me start with our chief economist, Nariman Behravesh. And Nariman, given what we're seeing about the resurgence of the pandemic, are we seeing that, in effect, that the economic recovery is slowing down, that it's tailing off? And let me just say, Nariman will not be maybe appearing on screen. I think he will be. Nariman, go ahead, and hopefully the video will work.
Great. Thank you, Carlos. I think the answer to your question is economic activity does seem to be slowing down in parts of the world. And that's strongly correlated with where the virus is rising again, its resurgence. So certainly the U.S. or parts of the U.S. Are in this mode, whereas other parts of the world, like Europe, where they seem to have the virus kind of under control, although it's not totally under control, certainly confidence is improving, and there's a chance that the rebound will be fairly strong. But U.S., Brazil, Israel, India, these are countries where the viruses are taking off, and we've seen a lot of the high-frequency data rolling over after May and June increase in things like restaurants activity and mobility measures in the U.S., again, Japan, actually, Israel, and some other countries. We're seeing these numbers top out and come down. So there is slowing, but it's not pervasive. And even in the U.S., some of the large southern and western states are getting hit hard, whereas in the Northeast, things do seem to be improving, both in terms of the virus and economic activity. So it's very much of a mixed picture.
Chris, the Purchasers Managers Indices have been suggesting that there has been a business boom. Does that contrast with the mixed picture that we're seeing on the economic front?
Well,
no,
the answer is yes. Go ahead.
Up here, my survey is actually. Sorry, up here, my survey is actually back up what Nariman's saying very much there. So we've got preliminary data for July now, which showed. Well, we've got the four major developed economies: the Eurozone, US, Japan, and the UK. And they showed growth. I mean, that's half of global GDP. And growth there accelerated in July, but it's only it's equivalent to around 2% per year growth. So given what we lost at the height of the pandemic, that's still a really quite lackluster rate of expansion. We even saw signs of weakness persisting, especially in Japan and in the US. In the service sector in the US, we saw new business inflows actually start to fall at an increased rate as those lockdowns were reimposed and everything took a step backwards. So it's very much a case of, yes, we're pulled right out of the depths of that pandemic, but It's a weak picture still, rebounding from a technical lockdown, but few signs of demand really gathering much strength globally.
Sarah, if you can take that picture further, we're rebounding to some extent, but weak. If you look around the world, and particularly in the developing world, what kind of picture are you seeing?
Well, certainly one of the reasons this is the most severe global recession since 1946 is that it's encompassing the emerging markets and developing countries. During the global financial crisis, that group of economies grew about 2%. This year, they'll be contracting about 4%. And as Nariman mentioned, the path of the virus is a significant determinant. While the U.S. has the most cases, the next 7 are emerging markets, specifically Brazil, India, Russia, South Africa, Mexico, Peru, Chile. Many of those countries are still in some form of lockdown. In India, for example, many of the urban centers are still in lockdown. Industrial production declines have been enormous. In Brazil, the economy had barely recovered from a deep recession in 2015, 2016. So now it's back on a path where we'll see probably a 9% contraction in GDP. That's the case around the globe. South Africa, another economy hit very hard that was already in a rather fragile situation.
Quite a striking situation where you have the United States and then followed by emerging economies. Joel, what's so surprising about what's happening in the United States? And we'll hear from Joe Krakener, chief economist for the U.S., but you won't be able to see him. Joel, please. Joel, are you with us?
Yeah, sorry, I had myself on mute, but now I'm here. Most striking to me over the last 6 weeks is the evident rapidity of the negative feedback loop between attempts to reopen the economy and the course of the pandemic itself. This is an exciting week for U.S. forecasters. On Thursday, we get our government's first estimate of GDP growth in the second quarter. We're expecting a number in the range of -35 to -40% at an annualized rate. But as Nariman mentioned, the high-frequency data is suggesting a trough in the spring and a recovery since then that has positioned the third quarter growth in the United States to be a fairly strong positive. But in the last month, the resurgence in infections has been highly correlated with a bend-off in all the high-frequency data that we look at. And we have a variety of such data now. We have daily data on air traffic, on restaurant seatings, on rental car activity, on vehicle sales, on credit card transactions. We have weekly data on the number of small businesses open and the number of hours employed at those businesses. We have weekly data on unemployment claims, and all of that high-frequency data that's connected to the service sector seems to have been bending off, suggesting the possibility that once we get to the fourth quarter of this year, the negative feedback loop between attempts to reopen the economy prematurely in the course of the pandemic are going to be coming back in the opposite direction, slowing economic growth. There are 2 brighter spots in the U.S. economy. Housing has outperformed our expectations. There seemed to have been pent-up demand for building of new homes, and the supply there is very tight. It could be that people are beefing up their home situations, knowing that they won't be in their offices anytime soon. And also in the manufacturing sector, there's been a bit more of a robust recovery than there has been in the service sector. But what's really impressed me, and what I worry about as I sit down to open our new forecast round later this week, is how quickly the economic data seems to have been flattening out in response to the upturn in infections.
Striking. Todd Lee, if you could bring in a picture from Asia and add it to complete this sort of global view.
Sure. Well, Asia is quite diverse. So the recovery, the pace, and the sequence is very different. Then China, with the outbreak where it first happened, was leading the way in the recovery. Economic growth returned to the positive territory in the second quarter. Growth came in at 3.2%, follow a historic contraction in the first quarter of 6.8%. But growth in the second quarter is still about half the growth rate where China was posting before the COVID crisis. Other areas in Asia like Vietnam, Taiwan, and South Korea, where the outbreak is largely contained, recoveries are most promising and probably will be the first to begin to recover more robustly. But then other places you have like India, where Sarah and Nariman alluded to, as well as Indonesia, where the worst of the outbreak is still not over. So I think the worst of the downturn probably still not over. So we'll be drawn out for a few quarters.
It's striking in all of the points that everybody has made, the correlation between the virus and the economy. It probably shouldn't be that surprising, but indeed it's coming through in a very profound way. Sarah, maybe if we can turn the topic a little bit to questions about alternative scenarios, and people often talk about a W curve. Can you explain what that might be and what the risks are that are entailed in it?
Well, the global economy had a very sharp downturn in the February, March, April period, followed by a significant rebound in activity in many of the major economies during May and June. Now, certainly with the virus continuing to spread at a rapid rate, there is the risk of a second downturn, the quick recurrence of a recession, followed eventually by some recovery. But clearly this presents some major concerns. This is an environment of great uncertainty. A second downturn could have more damaging consequences for capital spending, for example, or consumer spending, even if the lockdowns that follow are not as severe. Also, we're in a position where there's less scope for monetary and fiscal stimulus. A number of businesses are operating on the edge. We could see more business closures in a W-shaped recession. And then, of course, loan defaults would be a much greater concern. Central banks eased aggressively back in March when we were on the tip of the financial crisis. With a second downturn, the risks of a more severe financial situation would resurface. And of course, we will see some long-term consequences from the COVID-19 recession, which would be exacerbated with a W recession, and that would include deeper spending cuts, people exiting the workforce, discouraged workers, which would drain our long-range potential. So clearly a W recession is something to be avoided. We've been giving it a probability of 20%. It's a path we don't want to go down.
Clearly a distressing path to think about, probability you're assigning of 20%. Joel, what sectors would be hurt most within the U.S. economy?
Well, obviously, activity that is dependent on social density, so leisure and hospitality, education, travel. But in this W scenario, the primary concern there is that the damage starts to spread beyond those activities that are just directly affected by the interaction between the virus and social distancing. So, for example, consider the airline industry, which currently has maintained its payroll thanks to federal grants and loans that were legislated as part of the CARES Act. The conditionality of those loans were that the airlines keep their employees on board until this fall. The idea was that this event would be so short-lived that by the fall, airlines would be up and running again, and they would be demanding the services of those employees. That's clearly not going to happen. The airlines have already announced through their unions that they intend to announce very significant layoffs in the fall. Tens of thousands of people across the major airlines, flight attendants, baggage handlers, caterers, pilots. Okay, and this was going to represent a spreading of the economic damage to the infrastructure beyond those industries that were initially the hardest hit. And that could only become worse if, in fact, we transition from the fledgling recovery into something like a W-shaped scenario in which there's a second downturn. So the longer it goes on, the more harshly we learn that the virus is the boss, and the larger, more widespread the structural damage to the economy.
Chris, how do you expect that economic damage to be reflected in the upcoming PMIs?
Yeah, so I guess the consensus, if you like, from what companies are telling us about their own expected paths is typified really by an expectation that, look, Q3, you've got a, if you like, a technical rebound that are taking place as businesses reopen and demand stimulated just by the mere movement of goods and services around with that opening up. But then companies are saying that hopefully we're going to see a more sustained upturn in demand in the fourth quarter. That's what they're banking on as the pandemic becomes increasingly a thing of the past or becomes more localized and contained and managed. Paving the way for a better 2021. Now, for that to happen, we've got to see some of the data really start to pick up in the coming months. Now, at the moment, while we've got this bounce in output, we don't have a commensurate uplift in other indicators like new orders, like employment. A lot of the employment numbers from the surveys that we're conducting are incredibly weak still, as firms are just hesitant to meet this initial bounce with more hiring. And in fact, the majority going in the opposite direction, saying that we still need to pare back our costs. We've had a horrendous hit to profits. We've got to pare back operations as much as possible as we go forward. So to get a V shape, the numbers have got to improve dramatically from where they are now over the rest of the year, and we just don't see that happening. The W shape that Sarah's talking about is more likely as we get this fade of some of these numbers, the new orders ones. We can't see that strength persisting, and we can also drill down a bit by the sectors. It's interesting to see there where recently up into June. We saw much more cyclically exciting sectors start to join in the recovery. Now, prior months, we saw the defensives, if you like, the food, drink, pharmaceuticals, healthcare performing best. Now that's being joined by the banking sector, construction and so forth doing well. So again, we want to see more of those cyclical sectors really start to enjoy recovery to get some assurance that you're not going to get a fallback. But at the moment, it does look like you've got some fundamentals that aren't strong enough to sustain the growth that we've got at the moment going through to the end of the year.
Todd, if you can continue the discussion on the fundamentals and what is necessary to sustain us, but put it in an Asian context and particularly a China context. Is China at a point where it can demonstrate that it's more on a V-shaped recovery? Is it beyond the risk of a W?
I don't know about V-shaped recovery because as long as there's no vaccine or effective treatment, things will remain subdued because there will be a lot of restrictions on businesses. There will be a level of fear amongst consumers in terms of how they behave, the things they could purchase normally under normal circumstances. But I think in China's case, although I think periodic local COVID outbreaks are probably inevitable, as we've seen, in June in Beijing and recently the reported outbreak in Xinjiang. But with China's established very large-scale testing capacity and the infrastructure they built up for contact tracing, they're able to contain the outbreak and make sure it's localized. And then the other thing we saw in Beijing is that the lockdown they implemented, I think they learned from their, the mistakes they made before. The lockdown has been very surgical, so make sure to minimize the negative impact. So I think the most probable scenario is that China probably will be able to avoid a W, but as long as the vaccine and effective treatment are not available, a V recovery probably is not likely.
Nariman, one of the questions that are coming in fact, several on this theme, are the success of different strategies that have been tried around the world that have been most effective at allowing for sustained economic activity. Are there particular examples that you would point to that give us signs of what good practice, what best practice might be?
Well, there are a couple of examples, I think, that could be pointed to. The first is South Korea. South Korea did a really, really good job of testing and backtracing, and they've had periodic flare-ups, but they seem to be able to contain it. Certainly the China story is also, in some sense, a success, although they've had a number of flare-ups there that are quite worrisome. Germany is another one where they seem to have things under control, but again, recently the government's expressed concern about flare-ups. So I think the basic issue here is that, and I think Todd mentioned it, we're not out of the woods, and we're not out of the woods until an effective, widely available vaccine is out there, and we don't think that's going to happen until the middle of next year. So I think every country, even the successful ones, and there are some, are under great threats as we go forward. So the virus is the wild card, and then in conjunction with that, something that we've all said here today is that the response, whether it's individual responses collectively or government responses, play into that and are, of course, very highly dependent on the path of the economy is very highly dependent on the policy response and individual response. Because I think there was a tendency, especially in the U.S., perhaps maybe less so in Europe, to blame the lockdowns on the economic downturn. But now that the lockdowns are off, but people are still very cautious, and it's very obvious that is almost the overriding issue here, more than the lockdowns, is the caution, extreme caution on the part of very large groups of people. And Joel mentioned this, but there was a survey that was done of frequent flyers. Right now, only 25% are willing to get on an airplane. That tells you something. And so that will lead, even without necessarily yet in a resurgence and a W, it will continue to mean a very, very lackluster recovery after that initial bounce that Chris and others mentioned. Certainly a bounce, a very strong technical rebound in the third quarter, but after that it's going to be fading. And so it's what we refer to as a bounce and fade, rather than what some people have referred to as a reverse or backwards square root sign, which is essentially the same thing. Sharp down, sharp up, but only halfway, and then flat.
Chris, let me move from the discussion that we've had that's an intersection with government policy to business strategy. And Nariman has laid out both some of the principles that are effective globally. If you begin applying this to the business sector, where do you see the prospects for growth and recovery? What are there points that give you optimism or particular pessimism?
There's from the discussion, there's going to be fairly obvious some winners over the course of the next 12 months. The most pessimistic companies that we're seeing are, of course, the consumer-facing travel and tourism-related sectors. We did a recovery survey when firms globally expect to recover their pre-pandemic output levels, and it was quite interesting variations. This is about 13,000 companies around the world reported to us, and Those that are expecting the longest impact from this are, of course, the hotels and restaurants and tourism companies. But we've got some construction firms in particular and manufacturing firms really seeing some very upbeat prospects. Around 3-month recovery times back to pre-pandemic, led by China and the US. And I think there's a pattern there, and it's this, these economies with very large domestic markets are generally the ones where companies are perceiving the fastest routes to recovery. Now, perhaps that's a reflection that, you're not reliant on exports, trade with other countries and travel to other countries. So that's where prospects seem to be good. Sort of making stuff, as long as it's not shipped around the world, and staying away from face-to-face contact. It all makes perfect sense. But it's interesting to see the surveys themselves show that's where the companies are the most upbeat. But the pessimism is all to do with travel and face-to-face contact.
Joel, people wonder and ask the question, why is the stock market so resilient in this kind of an environment?
That's the million-dollar question. First of all, we know from our measurements of investors' appetite for risk that they eschewed risk significantly in the spring and still are to a fairly considerable extent. That normally would give you a down market, but the S&P 500 is close to even for the year, only a little bit below record highs, and the NASDAQ has pierced record highs frequently over the last month. So what's going on? Two things. First of all, interest rates are extraordinarily low, and since stocks reflect the present discounted value of expected future earnings, and a low interest rate is used to discount those future earnings, the extraordinarily accommodative monetary policy that has pushed term yields down to very low levels is certainly one of the reasons for support of the market. Another factor is that investors apparently expect a very sharp V-shaped recovery in corporate earnings. If you look at consensus estimates of corporate earnings that are summed from the bottom up from forecasts made by individual country analysts, company analysts, it's almost shocking how quick a recovery in earnings those analysts expect. If markets are priced to that sort of expectation, that could also help explain today's apparent strength in valuations. But it's also, I think, really important to divide the market into segments. The tech sector has actually fared fairly well because, as you can easily imagine, there is a booming demand right now for home offices, video conferencing, and all the equipment that goes with it. So that segment of the market, I think, is fine. The energy sector, not so great. Okay, and the transportation sector and sectors related to hospitality also really struggling. So you do need to look past the headline numbers that we see every day for the Dow or the NASDAQ or the S&P and think about what's going on sector by sector, I think, to get a more balanced perspective on how the market's actually faring.
Nariman, when you take the sector by sector approach in the real economy, and one also thinks about the employment considerations, one of the biggest debates in the country right now is, do we need more stimulus? Obviously, it's at the center of the political debate in Washington right now. Without jumping into the political pros and cons, how should we think about this question of additional stimulus, what's needed at this point in time?
Yeah, it's a very good question, Carlos, and I'm going to pick up on something that Joel said earlier. The reality is, well, a couple of things. First, I think the stimulus didn't go to the places where it was needed most, but that's a whole different topic. The issue now is that a lot of that stimulus is going to go away. It ends, basically. And it's not just in the U.S., by the way. In Europe as well, a lot of the furlough programs are going to end. because the money's not there to continue them. So I think the answer is yes, we need more stimulus, and we need it to last. So it's not just the size, but it's the duration of that stimulus. You don't want it to end abruptly. You want it to fade out gradually as the economy is recovering. So in my mind, at least, we do need more stimulus, and we need it to be designed in a way that continues for a while until the economy's on back up and set on its feet again and doing well on a sustained basis.
Interesting point. Todd, let's take that to China. They've had much weaker stimulus now than they did after the great financial recession. What do you expect? What are the implications of the stimulus measures that China has taken?
Well, that's a really interesting comparison you drew, Carlos. The stimulus they did this time, and they're doing this time, and compare that with what they did during the GFC recession. I think the key difference is the effectiveness of the stimulus, and also the constraint. Because of that very aggressive stimulus they did back in 2009, 2010, they have incurred a lot of debt in their economy, especially in the corporate sector. And China's debt to GDP ratio is now about 250%. Corporate debt is around 150%. They've been trying to deleverage that, since 2016 to some limited success. So they certainly don't want to see that, come back up again. And the other issue is the effectiveness, efficiency of the stimulus. The efficiency in terms of the investment spending, which is where the stimulus money typically will go to generate GDP growth, that efficiency has deteriorated severely since the GFC, and partly because of all the excess capacity that they built up, with the investment spending, the money flew to real estate sector, helped fuel a bubble. So I think those are the factors that why China, was much more reserved, much more conservative with their stimulus measures this time. But the other issue is, I think the approach they took, similar to sort of, what I mentioned about the Beijing lockdown. So they've been very surgical. I guess given the nature of this outbreak, of this crisis, so they have targeted the more vulnerable elements of the economy, namely the private sector, the small and medium-sized enterprises. So I think to a certain extent, how they have limited the negative impact on the jobs market, I think has been relatively effective. We know that China's labor market data is not the greatest. Unemployment rate usually is pretty stable. But if you look at our PMI's employment index that Chris's team compiles, compared the downturn of China versus the other major economies, which also have this very severe COVID crisis, the cut on the jobs market in China has been much less severe. So I think for these reasons, I think that have been allowed. One, China can't really do a very massive stimulus, and also I think what they've done so far has been relatively effective. So the central bank actually recently came out and sort of beginning to signal that they may begin to exit the stimulus policy. So that sort of suggests that they're actually relatively comfortable with the state of the recovery so far.
Interesting. Let's look at the contrast then into Europe and in particular Germany. Sarah, if you could talk a little bit about the German recovery and the exceptional measures that they've taken at a state level.
Well, recent indicators suggest that the German recovery was continuing through July. Germany is in a somewhat unique position in that the country ran budget surpluses in each of the past 6 years. So those sound public finances enabled a more aggressive fiscal response to the crisis. And indeed, Germany's response amounted to about 14% of GDP. This included a reduction in the value-added tax, grants to small businesses and the self-employed, and then kind of more liberal terms for its standard Kurzarbeit program that essentially enables companies to keep workers on payroll, maybe reduce their hours, but pay them a full-time salary. And about 7 million Germans have participated in that program. So these stimulus measures certainly have resulted in a milder downturn in Germany than in many of the other Eurozone countries, but it's still severe. And keep in mind that Germany is highly integrated into the global economy, a major exporter, particularly of capital goods and automotive products, which have been hard hit. So Germany's economy is expected to contract about 6% this year, a little worse than the global economy as a whole, but certainly better than the 12% contraction we're seeing in the UK and the 8.5% average for the Eurozone.
Let me turn from that to drill down more on the U.S. economy. And Joel, if you could, it's totally unfair in an environment of this kind of uncertainty, but give us what you think is a realistic outlook for 2020. And one of the questions that's coming in relates to debt and what that implies for the long-term prospects within the United States.
Sure. Our current baseline forecast for GDP growth in 2020 is minus 6%, which is below consensus. And our forecast for 2021 year-on-year real GDP growth is 3.7%, and that's also a bit below consensus. In that forecast, GDP does not regain its previous peak until the middle of 2022. And even 10 years later, GDP does not regain the pre-pandemic path of GDP because there is, in our judgment, going to be a persistent loss of potential output consequent to the cyclical decline in investment spending that will leave us with a smaller capital stock exiting this event, and also the possibility that people who are at risk either because of their age or because of pre-existing conditions may be reluctant to rejoin the workforce even as the economy expands, so that with less capital and perhaps less labor, there'll be less productive capacity here in the U.S. And let's not forget that some of the capital that we have will be less efficient in the future than it has been in the past. Airplanes, baseball stadiums, theaters, restaurants were all designed to be fully packed with happy throngs of people producing lots of revenue, and going forward they won't be doing that, and you could think about that as a reduction in the overall productivity of the capital stock. So a recovery that will take several years to regain the previous peak of activity, and a persistent loss of output because we'll have less capital, maybe less labor, and less productive capital as well. Now, on the issue of debt, this is a very frequently asked question. It usually comes in two parts. Are you worried about the inflation consequences of the debt expansion, and what about the long-run impact of the debt on growth? On the inflation issue, not worried much at all. If the Fed retains its credibility as an inflation-fighting institution with a well-defined inflation objective, it has the tools to withdraw monetary accommodation as the economy firms and inflation begins moving towards the 2% objective. And our Ken Matheny, who follows the Fed very closely, is starting to advise clients that the Fed is now beginning to signal to the marketplace that they would even tolerate a temporary excess of inflation over the 2% objective in order to cement the long-run inflation expectations at 2%. Otherwise, there's the potential that they would drift down given how much slack there is in the economy. So I do think that the inflation risks here are probably to the downside, not to the upside. Now, long-term, when we exit this event, we are going to have a higher debt-to-GDP ratio than otherwise because there's been discretionary policy that has increased spending and reduced taxes, and there's been a cyclical decline in revenues that has widened the deficit as well. there will be long-run consequences to that. First of all, deficits and debt can gradually crowd out private sector investment and undermine our long-run growth and living standards. Second of all, when deficits are large, there might be less fiscal space to pursue countercyclical fiscal policy when the next shock comes around. Witness how much trouble Senate Republicans are having right now putting together a fifth stimulus measure this summer, in part because deficit hawks are clamoring about the cost of those programs. Third, higher debt means higher debt service, and higher debt service crowds out other priorities that could be worthwhile. If you're paying interest on a national debt, that's money that you don't have available to invest in healthcare, to invest in roads and bridges, to invest in education, and so on. And then finally, no one knows for sure when, why, or how it would happen, but a high debt-to-GDP ratio could eventually precipitate some sort of sovereign debt event. And if we're exiting this episode with a higher debt-to-GDP ratio, that sovereign debt event could be closer in time. So to recap, I'm not worried about the long-run inflation implications of this debt, provided that the Fed retains its credibility as an inflation-fighting institution. But there is a slippery slope in terms of our standard of living and the risk that global investors will eventually tire of absorbing all the dollars that we're supplying them.
Joe, that was an excellent answer. We only have about 3 or 4 minutes left, and so I'm going to abbreviate and group some of the questions here. Todd, let me turn to you on China's economic recovery. How strong is it? Does it give one a sense of confidence that it could be sustained, or are there vulnerabilities there?
Like I said, the economy has returned to growth, but still it's not very strong. The other issue is that the rebound is not very even. It's very uneven. So you have the industrial sector leading the service sector. You have the supply recovery leading demand. And within demand, you have investment spending leading consumer demand. So this is all what one would expect, as a result of this pandemic, that how the COVID, throughout the COVID outbreak, will limit how business operate and limit how consumers behave. So as I said, earlier, because of the scale of the testing capacity they built up, and the contact tracing they have set up, and then also, their political system and culturally, Chinese people, the Chinese population are more willing to subject to that kind of tracing. So they should be able to, keep the any new outbreak contained. So recovery will continue, but the issue is, I think we all mentioned this before, that without effective treatment, without widely available vaccine, things just can't return to normal. So I think recovery will remain subdued and remain uneven until that issue, the fundamental issues of the COVID pandemic is solved.
Sarah, does the world need a Chinese recovery to be able to serve as a demand pull for wider economic growth?
Every little bit helps, but the short answer is no. A robust rebound in China's economy might add, say, 0.2% to global GDP. And I think bottom line, this is a unique recession with service industries, domestic-oriented industries hit particularly hard. And so it's really tackling the virus, resuming some of the activities hit by social distancing requirements and lockdowns that will save the economy.
Chris, let me turn the discussion or the points around recommendations to the business sector. As one thinks through the discussion that we've just had, the uncertainties that are involved in the economy, the uncertainties related to the pandemic, And if you're looking at this from a business perspective and you're trying to read the signals of growth that you see in PMIs and other high frequency data, what are the one or two critical things that you would put on the table as essential to be able to monitor and pursue in order to be able to mitigate risk as you go forward?
Well, I think there's one real indicator that we need to watch here, and that's the labour market. I think this is going to be key to recovery paths. And it's that whole area of stimulus as well, which is so important at the moment. And I think there's a few questions here that allude to this as well. That at the moment, there's a bit of a zombie nature to many economies at the moment, with companies being kept alive and workforces being on payroll, still not even working in many cases, by government. And key to the coming months is how this is going to play out. Is there going to be enough demand for these companies to stand on their own feet without government aid, to keep their workforces employed? That's going to be the main thing to watch out. So I think it's all about the employment numbers going forward. It's every big business will be watching those labour markets to see how these recovery paths are playing out.
Nariman, let me ask you to do the impossible and pull all of this discussion together and the balance of optimism and pessimism and how we should think about moving forward as we look at this phenomenally uncertain situation.
2 months ago, I would have said the balance of risks is on the upside. It certainly looked like things were beginning to improve, and the strong rebound was going to continue. But right now, I would say the balance of risks is on the downside. Not so much in terms of a W or a double dip, as it's been sometimes called, but in terms of growth being sort of weaker throughout the world, not just the U.S., than what we're predicting. So I would say that's changed, and it clearly is very, as we've said repeatedly throughout this past hour, it's very closely correlated with the resurgence of the virus. So if we get the virus under control, either through people's behavior or through a vaccine, then we have a good shot at decent growth, not so much this year, but certainly maybe next year, the year after. But if we continue to have these resurgences, sort of second, third, fourth waves, whatever you want to call them, then I think the growth will be very, very weak. Maybe not another recession, but very weak nonetheless.
Nariman, thank you. This has been an extraordinary conversation, phenomenal insights. A few critical things that stay in my mind. The virus is boss, and it's going to have a dominant impact on what happens on any kind of economic and business activities, reinforcing the importance of a vaccine. We've talked about the stimulus and the importance of sustaining it, that its predictability is going to be a critical factor in its success. In the business area, the importance of looking at what happens in the labor sector as an indicator of what the prospects are coming. And indeed, recognizing these feedback loops between the virus and the economy and how they influence and affect one another, that has to be a critical consideration. To my colleagues from the IHS Markit economic team, thank you so much for the insights you shared, for the willingness to really pry and understand and discover how we work from this environment of uncertainty to being able to understand what the factors are that are driving it. And indeed, it's part of what we're trying to bring to you through these CERAWeek conversations. It's an environment where we can't necessarily predict the future, but we can try to understand the drivers of change, and hence keep joining us to understand what those drivers of change are in CERAWeek conversations moving into the future. Thank you.